I want to tell you something that took me an embarrassingly long time to figure out. Car insurance is not a fixed cost. It is a negotiable expense, and it varies by hundreds of dollars a year depending entirely on which company you choose to give your money to. Most Americans treat car insurance like a utility bill. They set it up once, they put it on auto pay, and they stop thinking about it. The insurance company builds their entire pricing model around the expectation that you will do exactly this. And they are right about most people. The majority of American drivers have not compared car insurance rates in over a year. A significant portion have never compared at all. So I decided to actually do the comparison. Every major car insurance provider available to American drivers, rates, claims experience, discount structures, and what actually happens when you need to use the insurance you are paying for. What I found was not what I expected. Here is who won. How the comparison works. Before the results, the methodology matters, because the way most people compare car insurance is almost entirely wrong. Most people compare monthly premium and stop there. That is like comparing cars by sticker price alone and ignoring reliability, fuel costs, and how the dealer treats you when something breaks. A proper insurance comparison requires 4 things. First, actual premium for your specific profile. Rates vary dramatically by age, driving record, vehicle, location, and credit score. A company cheap for a 25-year-old in Texas may be expensive for a 40-year-old in Ohio. Second, claims experience. This is what actually matters most and what almost nobody researches before buying. Your insurance has one job: pay when something goes wrong. Companies that score well on premium but poorly on claims handling are selling a promise they do not keep. Third, discount structure. Most people claim fewer discounts than they are entitled to. Bundling, safe driver, low mileage. The availability varies significantly by company. Fourth, accessibility. When you need help after an accident, can you reach someone quickly? Response time and service quality varies more than most people realize. The results: USAA earns the top position in virtually every independent insurance study, with one important caveat. USAA is only available to military members, veterans, and their families. If you qualify, the data is not close. USAA leads on both price and claim satisfaction by margins that make it the clear recommendation for eligible buyers. Amica Mutual is the name most Americans have not heard but should have. Amica is a mutual company owned by policyholders rather than shareholders. That structure changes the incentive to deny claims in meaningful ways, and Amica's claim satisfaction scores reflect it consistently. State Farm is the largest auto insurer in America by market share. That market share was not accumulated by accident. Competitive pricing, broad discount availability, and consistent claims handling across their agent network puts State Farm in the top tier for most buyer profiles. GEICO wins on price for a large percentage of driver profiles with clean records and good credit. Claims experience is more variable than the premium pricing leaders, but for buyers primarily optimizing for lowest monthly cost, GEICO frequently wins the rate comparison. Progressive does its best work for non-standard situations. High-risk drivers, specialty vehicles, and buyers willing to use behavior-based pricing through their Snapshot program. If you drive low miles and drive safely, the Snapshot discount can be meaningful. Allstate tends to price higher than competitors for equivalent coverage, but the discount structure is broad, and the agent network is one of the largest in the country for buyers who value local relationships. What actually matters most? Here is the honest conclusion from comparing all of these options. For most American drivers, the difference in annual premium between a competitively priced company and an uncompetitively priced company for identical coverage ranges from $200 to over $900 per year. That gap exists not because one company provides better insurance. The legal coverage is the same. It exists because companies price risk differently and because some companies bet their customers will not shop around. That bet pays off consistently until you decide to stop being that customer. The single most effective thing you can do right now is get quotes from at least 3 providers using the exact same coverage levels. Use comparison tools as a starting point. Then call your current provider with the best competing quote and ask them to match it. You will be surprised how often they can, when they realize the alternative is losing you. Final thoughts. There is no single winner that is best for every American driver. The right answer depends on your specific profile, your age, your record, your vehicle, your state, and how much you weigh premium cost against claims reliability. But the universal conclusion is clear regardless of which company is right for you. You should be comparing. You should be asking for better rates, and you should be doing it at least once a year, because your profile changes, the market changes, and the rate you locked in 18 months ago is almost certainly not the best rate available to you today. If this video helped you think about your insurance differently, hit the like button. Subscribe to AmericanRevHead for honest car money content every week. Drop a comment below. When did you last compare your rate? The answer might surprise you. Until next time, drive smart and stop paying more than you have to.